what is happening in the stock market today. I wanted to break down inflation data that we got this morning that really rocked the stock market today. The S&P 500 today is down about 1.75%. The market's actually still going. This is the last 20 minutes or so of the market today. Nasdaq again down about 1.8%. And I wanted to break down the data within inflation numbers and show you what is likely to happen ahead. And have we seen the peak in the stock market? Let's jump into the computer and I'll break down the stock market today. Inflation data came in this morning a little hotter than expected. Most people would have expected a much smaller increase month over month. We're basically looking at 0.4 increase month over month. All right, break that down. Multiply that by 12 without compounding. That's almost 5% inflation rate at 12 months. Core rate slightly lower, but still nowhere near the 2%. And I've been saying this for a minute that this economy is much hotter than expected, and all you have to do is look toward what's happening with the consumer and how the consumer is really starting to advance a great deal. Because of that, inflation data is starting to move higher. Interest rates are going to remain higher for longer. Dollar went higher. The bond yields shot up. Let's break down the stock market today. Here, first off, however, here's the U.S. CPI headline numbers. As you can see, we had the big shoot higher, but a lot of that, something like 70% of that, was housing. Well, bad news. Housing is starting to move higher again, and housing inflation in today's number was moving upward again. So that's something you got to keep an eye on. Take a good look at the mortgage rate. I've got that chart here in just a second. The mortgage rate, I've got the Case-Shiller house price index chart. I'll show you in just a second. That is showing that house prices are moving higher as the mortgage rate drops from its most recent spike higher. People are entering back into the housing market, pushing housing prices back upward. This is creating the inflation. So that's a factor that's going in there. But consumers are getting back into the habit of spending. We saw retail sales the past 2 months have been sharp. Thursday we get retail sales again. So here's core inflation versus personal expenditures. And this is where I start my analysis. When I want to do stock market analysis, when I break down the stock market today, looking at SPY stock or QQQ, I always take a look at personal incomes. As more and more people get on the payrolls, that's more income for the country. And as we've seen pay raises happening throughout those who are already employed, this is more and more personal income, which translates into a higher and higher rate of growth for personal expenditures. That's the blue line you see right here. The red line, of course, is inflation. As expenditures, so go inflation. There's a bit of a delay. So we're seeing personal expenditures moving higher and higher. Sure, we'll probably see core inflation drop somewhat, but then shoot right back upward. I don't see any Federal Reserve interest rate cuts this year. I see them possibly moving a quarter point higher or maybe a half a point higher, but nonetheless, a bare minimum, the Federal Reserve keeps interest rates at this level probably for a big chunk of this year if they aren't forced to move interest rates higher. As incomes increase, as expenditures increase, this will push inflation further. There's a delay. Just kind of line up that chart. You can see the bottoms of the little blue dips there, and it takes a couple months before you see the moves in the red. We're going to see more inflation hitting. All right, money supply, the liquidity of the economy. Without money, we go nowhere. And as you can see, the money supply, we had what I like to refer to as a flyover. When the Federal Reserve started raising interest rates like they did, you see how there was sort of a pause and they shrunk the balance sheet. But what's happening is this is a fractional banking system and banks are starting to lend, creating more money. That is the lubricant that will push this economy forward. Keep an eye on money supply. Mortgage rates dropped a little bit, spiked up quite a bit off of, say, those who got 3.3 or 3.5% mortgage rates just 2.5 years ago. So it spiked up, pushing close to 8% over the past few months. I think it was back in October we saw those big moves higher, kind of resting right around 6.5%. I think it's about 6.65 right now for the mortgage rate across the nation. As this mortgage rate continues to sort of either maintain this level, affordability happens more so than where mortgage rates were just back in October. This is starting to push housing. Case-Shiller Home Price Index, as you can see, spiking back upwards. The inflation numbers we looked at today pushed because of prices moving higher in housing. That's what drove things up. 70% of that big spike up in inflation previously. Now we're looking at it happening again. The fix for this is real simple: higher interest rates. Stock market today. Here we're looking at the S&P 500 today. There's still a few minutes left, probably about 15 minutes left as I'm recording this for the stock market today. And as you can see, we got a little pop up towards the end. Could go either way, but basically the day's kind of cemented that this was a sell-off kind of day. Let's take a bigger look at the S&P 500 for today. And as you can see, this trend is still going higher. And if you look all the way over to the left of this chart, this is the very low point in October, moving into November, when the S&P 500 started its big move higher. SPY stock, or QQQ for those who trade the ETFs versus the major index, Nasdaq, and of course S&P 500. We're still in the trend. And the fact is, there's still a great deal of value left in a lot of these stocks. The 10-year Treasury yield is now up to 4.3%. But if you broadly look at the S&P 500, and I show this chart every time I do the stock market today, the review, when I break things down. I think I have it on. I'll show you here in just a second. I took the S&P 500 and I break down just one share, and I asked the question, each stock, what's the yield? Looking at the next 4 quarters. All right, add those 4 quarters up, earnings per share, expectations, divide that over the current price. That gets you your future yield. The S&P 500 today is trading at about 4.81% based on current prices. Probably that yield is going to move a little bit higher as price goes downward, but it shows that there's breadth. See, the S&P 500 is 500 stocks. It's not just weighted heavily with the Magnificent Seven. And because of that, we're seeing some of these smaller stocks. People are stepping in, value investors, nibbling at the bottoms and pushing those smaller yielding stocks a little bit higher, smaller stocks with higher yield. So there's still value there. And given the current interest rates, it's obvious that this economy is moving forward. So we may see the S&P 500 move right back upward in the next couple of days. Thursday we get retail sales. That will probably reiterate that we have a smoking hot economy. The consumer is moving forward, but so will inflation. The Federal Reserve is going to have to start making announcements. Listen, we're not happy. That's when you're going to see the S&P 500 start taking a bath. In the meantime, Treasury yields, U.S. 10-year Treasury yields, as you can see, kind of moving upward. I printed this chart. This is the 1-hour chart on the U.S. 10-year Treasury yield. Spiked upward, and I think it's about 4.31 finishing up for today. I don't know that we're going to push necessarily to the 5% level with the U.S. 10-year Treasury, given the information we have today, even though we have a hot economy. We're going to see a couple more pieces of data. And so the U.S. 10-year Treasury yield might back off a little bit, maybe come back down to about 4.225, somewhere in there, mellow out a little bit, and just sort of hang out until we get the next piece of economic data, and it sort of solidifies that, yeah, the Federal Reserve's not done. They didn't go from near zero to 5.5 and say, nailed it. They didn't do that. There's always fine-tuning. But as this flyby finishes up, as the money supply continues to start moving back upward, as expenditures move higher because of personal incomes moving upward, the Federal Reserve is going to have to do a little more than just tweak a few things. The VIX. Now, I put a trade on the VIX last Friday. Was quite happy with yesterday's little spike. Took 50% of my profits. Took the other today. But I want to show you PCC, which is, if you, I use TradingView for these charts. If you go for PCC, I don't know which system you're using. PCC is the symbol for put-call ratio. I'll show you that in a second, but just for, let's pause here for a second. So what I did is I had sold some puts on VIXY, VIXY stock, the ETF versus one of the ETFs. There's about 4 major ones against the VIX. And I bought calls. So yesterday's pop higher, I was pretty happy with, certainly, but it happened before today's announcement. What happened was a lot of people got nervous yesterday, started buying puts. Put-call ratio shot up. Today, of course, the value of the individual puts expanded, but the put-call ratio went down, meaning people sold off their calls or their puts. U.S. dollar index shooting up. There's a differential between one country and another. If you can borrow in Japan at near 0.15, wherever they are right now, and deposit it into some kind of high-yielding treasury here in the United States and get 4.5% or 5.5%, you get that differential. You borrow trillions from Japan, you deposit it here in the United States of America, you earn that differential between what you're paying in Japan and what you're earning here in the United States versus U.S. Treasuries. So that's why we see the dollar index spiking higher, because of that differential. It will probably continue to expand. But if we see interest rates needing to move lower in the United States, the U.S. dollar index gets a bath. Last thing I want to show you, gold spot. So this will be the last thing for the stock market today review that I'm doing here. Gold, of course, taking it pretty hard because higher interest rates mean higher carrying costs. And capital-intensive companies that are mining gold will take a hit on this because their costs will go higher. Gold moves lower. I break down the stock market today, SPY stock, QQQ. As well, S&P 500 today and Nasdaq today. So if you're looking for that kind of content, make sure to hit that like and follow button. I break down the economy and how it pushes the stock market. And in this case, the economy is really going to be front and center over the next couple of weeks and months. Make sure to hit that like and follow button. We'll see you in the next video.